G'day, folks. I've got a real treat for you today. We're launching the first edition of the Rough Consensus podcast, which is really a set of conversations, talking between friends, talking between different analysts in the space, to just try and get a bit of a gauge on where we are in the overall cycle, how market structure is changing. And for this first episode, there is no one better to have on than my good friend, TXMC. Now, I've known TXMC for a number of years now. We actually found each other from the world of on-chain data, but really he's done an enormous amount of work understanding how the macro economy works, how Fed policy and rate hikes, rate cuts, all of these things influence the broader market dynamics. So I'm super excited to get stuck into this particular episode. It was a fantastic conversation. Let's get stuck into it. I hope you enjoy. Cheers. Mr. TXMC, mate, how you going?
Doing well, Check. Great to talk to you, my friend.
Yeah, likewise. No, it was good to catch up in Texas, no less. Catching up with TX in Texas.
Yeah, got to show some Aussies, some Tex-Mex cuisine for the first time, so that was exciting.
Yeah, absolutely. And I'll tell you what, it's been a bit of a whirlwind, right? I mean, we went to the Nashville conference, and it was just this perfect example of like how markets and people just don't position themselves for what's coming. And, everyone's like, hey, look, Trump's going to say something, Bitcoin's going to moon, everyone's going to be super hyped. And of course, we're at 68K, and it was great, right? We bounced off like, 48,000 Bitcoin worth of German sell side. Everyone buys the excitement. And next thing you know, we're hitting a 40 handle, right? We got down to like 49K. So there's nothing quite like a bit of volatility. And honestly, thank fuck we got some volatility because it's been so quiet. But, to me, as soon as I saw this sell-off, I was like, TX is the man I want to talk to, because you've been thinking about this like really long-term thesis. And people don't usually think long-term, but you've done such an enormous amount of proof of work. I just had to pick your brains and find out what your thoughts are on kind of the broad picture of where we stand.
Sure. Yeah, it's been a remarkable journey the last couple of years, watching the cycle unfold and having some opinions about how it might play out, and spending a lot of the time feeling like I was an idiot, and other people telling me I was an idiot, even now, even still. But when we talk about a business cycle, it is a long process. It's a multi-year process. Even from the period of time when the central bank gets involved in raising interest rates, which happens in every cycle, and it usually starts much earlier on in the expansion than what we experienced in this most recent time. But even when they get involved, from that moment until the outcome of the cycle is often 2 years or more, right? And they just got involved in March of 2022. I'm sure we all remember that just as soon as like 3-4 months into the hiking cycle, everyone thought we were going to have an imminent like doom recession. Everything was going to go to shit. We actually had a technical recession briefly in 2022, but it's hard to know how much of that was just maybe normalization from all of the excess from COVID, right, which broke every single chart imaginable. But this has been a really fascinating period of time to be a market observer, to be a student of history and markets, because I really do feel like we're going through not only the kind of difficult end of a business cycle whose outcome is undetermined, but I do think that even beyond that, the next 5, 10, maybe 15 years could be a period of tremendous global change of the likes that we haven't really experienced in any of our lifetimes, certainly for maybe about a century. And not that we have to repeat the 30s, but I do think that we've had kind of a status quo globally for a long time, and many of those forces are starting to kind of elbow turn around the same time. And we're going through this post-COVID Frankenstein economy that the Fed basically just stepped in front of. They just stepped in front of a moving train, and we're still waiting to find out the outcome. And when you study these things long term, as I said, it is a multi-year process. And I think that's the thing that has tripped up the most people trying to call the end of the cycle. People who've engaged with me on my research and asked questions, they tend to be like, well, you've been talking about this for 18 months and nothing has really happened. I said, yeah, that's because that's how long it takes. When I first laid out my original kind of thoughts that the cycle was most likely to end in a recession, and we can get into why those things might be true. When I first laid all that out, that was Q3, Q4 of 2022. That was when I really started to pull all the data together and really study it intensely. And around that period of time, I said, if this actually happens, it might not manifest until Q4 of 2023 into the first half of 2024, because that's how long it takes. And even then, that's a massive window of time, and that's just a probability, right? That's just the heart of the distribution of all of the historical cycles. And we're right in the middle of it right now. And as we watch this data unfold here, economically, look at the growth figures, see the slowdown in job growth. You see the distortions created by large government spending that have kind of made the economy look stronger than it is. A lot of those forces are still trending in the same general direction of a slowdown in the economy rather than a reacceleration. And so I remain concerned, and my base thesis hasn't yet been invalidated. And because of that thesis, that is what has informed my general thoughts that this crypto cycle, Bitcoin, it was unlikely to be as exciting as cycles past because of the economic headwinds and the macro setup, which is significantly different from any of the previous bull markets for Bitcoin.
Yeah, 100%. There's so many things that I want to touch on. The first one is this concept. I think I first heard it from Jeff Schneider, and this concept that most people, when they look at rates increasing, they think, oh shit, the market's going to slow down because it's going to be tighter. Mm-hmm. But it's actually the contrary. It's you raise rates when the economy is booming to slow it down, right? And then the other side of the equation is you get these rate cuts, and it's been amazing watching the market when pivot. And the thing is that when they pivot, that's because the economy is weaker and that actually needs rates to stimulate because things aren't going very well. Mm-hmm. I also, macro is one of those things I just study as a student, right? And you got to go and find people smarter than you. I don't spend all my time looking at the macro because it's just too big. No one person could wrap your head around it. So you rely on other people to kind of form the pieces of the puzzle. And you and I were talking about this at the bar in Texas. Is Paulo macros? I love it. It's inflationary recessions create monetary illusions.
Great line.
It's such a great line because the idea is that you've got this enormous injection of capital from 2021 and 2020, the COVID stimulus. That's I've heard it described like a python, and it eats this enormous meal, right? Which is the giant stimulus that gets stuffed into the economy. That takes the python doesn't digest that overnight. That takes weeks to get rid of the goat. So it's one of those things where the market has to actually absorb that money. It's got to flow through the system. It slowly but surely gets taken out by taxes and all those things. But then those taxes are getting pumped right back in. And this concept, I like the idea that we're all paying a put option that, because of the amount of debasement, because of the deficit spending, this is this giant ball of inflation that gets putting into the market. It stops the left tail for a while, and people then become complacent. They start expecting that there will be no left tail, right? Now that doesn't, I have one of my theses that maybe we don't have one of these enormous kind of massive sell-offs, Great Depression, but there's also what's the gravity of the situation and what's the managed outcome of the situation? Because those are two different things. The gravity is that if left to its own devices, the market would probably go very, very south. But the outcome of that, the first, second order effect, is that they're going to have to stop that. There's this what's the gravity? What's the actual managed outcome? And I guess that touched on one other point I wanted to get your thoughts on. Can the Fed actually stop this? Because, we're seeing all of these catalysts start to unwind. Does a rate cutting cycle, to me, that is actually a point of concern and fear because the economy is slowing enough to do that. You need the stimulus to come in. Is this one of those balls that's rolling and the Fed's going to be they're going to try, but it's going to take a whole lot of pain before they can actually turn this thing around? What's your gut feel on all that?
Yes, this is something I've been really trying to work on, how I articulate it to folks, how I frame this perspective I have, because I think that we are set up for a real doozy when the Fed feels that they have been compelled to lower rates, right? Because what you said is so true, that we raise rates in an expansion, if you look at markets and yields over time, the interest rates rise slowly as the market rises. And during that period of time, credit is rolling, right? People are taking out new loans at incrementally higher costs of capital. And eventually, after a couple of years of this, usually we run to a point where like debt service costs are just imbalanced. There's excesses in the economy, and the cost of capital is too high to continue growth at the pace that it's been at. And we have typically a recession, and that's when they cut the interest rates. Um, most investors right now, their memory of how that process works looks like March of 2020. And that is unfortunately the most anomalous possible example you could use of what that's supposed to look like normally.
That's the last war. Everyone's fighting the last war, and that is literally the last
Correct.
war.
Right. Just like a lot of the older generation of investors, their only concept of a recession is the great financial crisis, and they're always looking for what's going to crash the housing market, and they're fighting that war. All of the crypto natives and all of the younger investors, millennials and the Gen Zs, they're all looking for the COVID V bottom and the 120 billion a month of QE to come back on, and those. I don't think either of those are going to happen exactly like that. I think if we're going to pick one of the two that's more likely, the great financial crisis sequence of events is more like what normally happens rather than what we saw in COVID, right? Every era has its own kind of unique flavor, but there's a certain pattern to it. And what I think is setting up to be really difficult for this cycle is I mentioned that in an expansion, rates go up slowly, and during that time, new loans are taken out. The cost of money for businesses and households slowly rises as rates rise. And then when the Fed stimulates by cutting, when we get into the recessionary downturn environment, by lowering rates really rapidly, they lower that cost of capital. And eventually it gets to a point where it stimulates demand, right? In the middle there's actually a downturn of pain, of closing of leverage, of the resolution of excesses, all the kind of bad things that happen at the end of a business cycle, the closing of businesses, defaults, bankruptcies, all that kind of stuff. But then the lowering of rates actually creates a stimulus effect. And in our lifetimes, yours and my lifetimes, in every single crisis that we've endured, the Fed had a back door in that they could lower rates below the floor that they were at in the previous cycle. And so that stimulus was extremely effective. And that was really enabled by what Paul Volcker did in 1982. But because he jacked rates up to almost 20%,
he put the potential energy into the system.
He put the potential energy into the system. And so we have been riding on that energy for 40 years. And every crisis, we set a new lower low. And not only did we allow existing debts to kind of be resolved, but we created a new stimulus. We allowed people to take out even cheaper debts and refinance for homeowners. That's a massive stimulus channel in an economic downturn, is the refinance channel. And it's worked really well for 40 years. But we just spent, the better part of 15 years at the zero bound. And during that period of time, we collected a lot of debt.
And that's the thing, that whole process of rates coming down created the debt. And now you've got this enormous pool of debts. Mm-hmm. And I think Julian Brigden does a good job of explaining we're now a refinancing mechanism. We're not a new financing mechanism.
Correct.
The system has to refinance all of the new debt. And then you've got all these very interesting, geographical differences. The US, you guys have got fixed mortgages. So most homeowners have not experienced the higher, they don't care. Put rates to 100%. I don't care. My house is locked in at 2 or 3.
Exactly.
Here in Australia and Canada, whole different ball game, right? People are immediately, we got 5-year fixed, and then the remainder 25 is variable. Most people over the course of the last 18 months have rolled off their COVID level locked in rates, and they're now starting to really feel the pinch. And the other thing is that because the US is so big, I mean, Australia could do whatever they want with their rates. It's irrelevant. The only thing that changes is going to be our currency. But for you guys, your rates, they project across the rest of the world, because why would you own Australian government debt when you can own US government debt, right? It's just not the better asset. especially when you're earning more yield anyway. So there's these dynamics where like different countries are going to struggle at different points in time. And it's just that whole interconnected system of refinancing who, when, and what does that do to the supply?
Exactly. And the trouble for refinancing, which is it's one of the key channels by which we dig ourselves out of a downturn. And so if you think about that, and then you consider where we just came from, we just came from the zero lower bound, right? And there was a window of time from 2020 until 2021 where we had a massive home refinancing wave. We had a massive terming out of corporate debts. Everyone took the opportunity to lever up and lock in lower debt costs during that little window of time. And in that window, that 2020-21 window, US 30-year mortgage rates hit all-time lows. They went below 3%. It's never happened before. And so homeowners like myself refinanced at a 30-year fixed 2.75% mortgage rate.
Wow.
And I'm never getting rid of it. And so
everyone except the government did this.
Right. But the problem, Check, that I see is that right after that, the Fed raised rates at one of the fastest clips that we've ever seen. We went from essentially 0 to 5.5% Fed funds. And in that little window of time there, almost no new debt was rolled. Almost no debt was rolled, marginally, nothing. Mm-hmm. And so we've created this chasm where if you just imagine the interest rates have shot way up into the sky, but all of the fixed costs of debt are way down at the floor. And so if we just get into a period where incomes are stretched, where debt service ratios and people's balance sheets are just a little bit unhealthy, and they're looking for relief. Let's say the Fed starts lowering rates. Maybe we get a negative jobs print or two, and the Fed says, "Hey, we're going to start lowering rates. We already said we wanted to cut, so we're going to cut 25 basis points. We're going to cut 50 basis points. Heck, we could cut 100 basis points." They could do all of that, and it still would represent a net increase in borrowing costs for the average borrower, because so much debt was created at essentially the lowest possible rate that it could be created at. And the global reserve issuer is not going to push interest rates negative. That's just not something I think is plausible.
It has to set a new higher low.
Right. And so what has to happen? The way that you secure a soft landing, right? This is a big debate right now, is are we going to have a soft landing? The way that you secure a soft landing, it's not just about jobs. It is about the economy accepting a higher cost of capital, right? And credit rolling at that cost. This process we're talking about, the refinancing channel. And if you have the Fed raising rates at one of the fastest clips ever, but the economy is not accepting that rate, right? If you look at the mortgage market, no one's taking out mortgages. If you look at commercial and industrial loans, which are business loans, the rate of growth of those is the lowest it has ever been in any era ever outside of a recession.
Especially no new debt creation, because the market people haven't gone, now is a great time for me to refinance. Now is a great time for me to buy a new home. They're actually saying, I'm going to sit right here and just wait. Even if I don't particularly like my house, I'm not even going to take a new job because it will force me to move.
Mm-hmm. Yeah, I mean, a couple of reasons for that. One, the locking in of low rates. And so the Fed, even if the Fed cut back to 0, mortgage rates would be 3 or 4%, because that's where they were from GFC to COVID. They're still higher than what I have. And they went so low because we had rates at 0. And because of all the stimulus, the demand for mortgages pulled the yields down even further to a floor that they'll probably never see again. And so that's one of the problems, is the chasm. But also, like, if you look at the distribution, two things. If you look at the distribution of mortgages, 50% of all U.S. mortgage balances have a rate of 4% or less. 75% of mortgages have a rate of 5% or less. The current mortgage rate is 7%. So if the Fed cuts 200 basis points and you assume a relatively consistent spread there of 1 to 2%, you're still not providing relief to homeowners, and that is the consumer. And so I just think this is a real problem for us, particularly considering that the prices of homes have continued to go up on a national basis during this entire process. So we've raised rates, and the homes have just become more expensive, or they've stayed about where they were, depending on your region. And it's just, I don't think anyone really has this in their bingo card, that when the Fed starts to cut, it does very little to the economy. The same way that them raising rates seemingly had no impact on consumption, because this is not a credit-driven cycle. This is an income-driven cycle. We have been powered by some of the strongest wage growth in a lifetime, and dis-saving, right? The drawing down of the savings that was built up in COVID. Those two things have kept us afloat because no one's taking out any credit. And so I that's my main concern, is that the exit out of the zero interest rate regime is not likely to be elegant, that we still haven't done so. And we can't secure a soft landing until we see the economy accepting new rates and taking on new credit, because we are a credit-based system. We need debt to roll. Banks need to do business. We can't just run on wages forever. And so that is unresolved, and I don't see a clear path forward. And I think because inflation is elevated, because inflation naturally restrains the response of the Federal Reserve, because it is their nemesis and they want to make sure it's defeated. So they take their time with it. This goes back to the 70s. They were slow in the 70s to respond. Or they're slow to respond here, or at least slow to ease, because they want to make sure that it's defeated. That, plus these problems we're talking about with the lack of effect from lowering rates, I think that I don't know how else to phrase it other than it's just a quagmire. I don't really know how we're going to get through it. And so my concern is just that we continually kind of drift downward in this economic malaise, and that the Fed never really does enough to stimulate the way that they should, because the signals aren't there for them. And we've fucked things up by having zero rates for too long.
G'day folks, I just want to take a very quick moment to remind you of our partnership with the Bitcoin Advisor, who are market leaders in the world of multi-sig vaults, collaborative security, and inheritance planning. As I grow older, I found myself thinking more and more about that long-term question of what would happen if I didn't come home one day, but also the security and peace of mind of how do I secure my seed phrase and my coins for life. Now, what I decided to do is run my loved ones through a test, and without any of my guidance, spend a coin from my cold wallet. And what I quickly found out is there was a whole laundry list of ways that my coins could have become lost, locked, or sent to the wrong address, and I just didn't have the confidence they'd be able to access my proof of work if I wasn't there to help them. So the Bitcoin Advisor has a team of people around the world. Many of them are my friends, and you've seen them on Twitter, podcasts, and in the conference circuit. They are there to help onboard people and remove those single points of failure, many of which you may not have thought about in your long-term custody setup. So if you are interested, head over to our landing page in the link below, book a free, no-hassle consultation, and secure your coins for life. Thanks, and let's get back to the episode. And honestly, as you describe all of that, the one word, if I was to describe, you said quagmire, I was thinking stagnation. It's just those, I think those are really the crux of things. And I mean, all of my subscribers are probably sick of hearing it, but to me, this feels like chop solidation, right? And chop solidation, but this is like on a massive scale, not just, not just what we've seen with Bitcoin's price action. There is this concept that I've been playing around with, this put option I was saying, because we do have I do believe there's a net inflationary backdrop here because of all, deglobalization, all that kind of stuff, deficit spending. And that's the thing, right? The natural gravity of this system is that I agree. I think that the age of the central banker is probably over. We're moving more into the age of the politician, right? Or we're in that phase where Jay Powell can't, if he raises rates, cuts rates, I don't think it changes anything because the market is going to do it for him. We're seeing that with US bonds, right? We're close to getting that 210 inversion. I think it hasn't quite flipped over yet, but all the other ones have. So we've got this concept of stagnation, this idea of like, what does that do to markets? I have a very high probability. I don't know like what's higher or lower. I still think there's like a lot of pain and fear to the downside. That's a big like factor of this whole thing. However, I also can't shake this feeling that what are they going to do? What is the actual response to this going to be? Because we also know that probably the only thing that they fear more than inflation is a depression, right? That the Fed's trying to fight both of these two things. So does this look a lot more like a lost decade type mechanic where it's a lot of chopping around, but ultimately going nowhere. A lot of like markets just not being able to get any kind of lift off. There's enough of a put option with deficit spending and all this, money getting pushed into the system, but it's never enough to really juice and go to that next plateau and really get this thing moving. I listened to a great podcast with Sven from Northman Trader, and he was, I think it was on Thoughtful Money. And I walked away from that pod. I watched it's a highly recommended. He like shows all these charts, and you mentioned it earlier. These charts just don't look like anything else. So like in terms of like, is this time different? I mean, yes, like quite factually, it is different. It is quite literally different. And it is different in so many ways. And there's, one of the things that he was saying, I can't remember the exact structure of it, so don't quote me. I think it was like the advanced decline type process where you've got this, the stock market looks great if you only look at the top 7 stocks. Right. Exactly. And then we get this weird rotation where, and this is like, there's all these different catalysts. I think maybe we can talk about these different catalysts. One of them is obviously the US election. I think that's a part of it, probably not a majority part of it, but there's obviously a lot of uncertainty. I've seen a bunch of charts that kind of shows what it looks like when you've got a known incumbent that's running, what happens when you've got, an open field. And, when you've got more uncertainty, markets can deal with good and bad news, but they are not very good at dealing with uncertainty. And right now, it's a coin flip between who knows what's going to happen. It's complete circus. You mentioned all of the debt. If they were to lower rates, in theory, that makes the US dollar less attractive. But then you've got this yen carry trade that's been imploding over the last couple of days. And that's only going to make the yen stronger on a relative basis. So in theory, that's going to make that unwind even worse. So like if you're Jay Powell, I mean, this is the thing. I give Jay Powell credit because he did something that nobody thought could be done. 5.5%. Incredible. I mean, honestly, no one did. I don't think anyone in the world did. He did it, but he's still backed in a corner. I mean, I wouldn't want that guy's job. I'd be resigning tomorrow. But he's honestly, he's dealing with an intangible system. It cannot. There's no good option. If he raises rates, he's going to break the system. If he lowers rates, he's probably going to break the system. If he does nothing, he's probably also going to break the system. Like it feels like they're in a real tight spot.
It does. I agree with you about Powell. He pulled off what most people thought he was going to drive us straight into a wall, or that we were going to hyperinflate. Like those are the two outcomes. No one thought he was going to get Fed funds past 2%. I
remember the rhetoric because that was the previous high, right? And everyone's like, "Oh, it always falls over," and he more than doubled that level.
Exactly. Yeah, everyone thought we were just going to set a new high, a new lower high, just like we did for 40 years. But they didn't realize that we just bounced off the floor for 15 of those years, and so there was nowhere else to go. And if you look back at interest rates, long-term interest rates, like if you look back at the turn of the 20th century, that was a period that shares some similarities to this period where we had kind of an unwinding of a period of global trade cooperation. Those things started to deteriorate. We had interest rates globally kind of drifting down throughout the end of the 1800s. And then as we came into the new century, rates started to rise, globalization started to kind of unwind, and it set up like a multi-decade period until we got to the Depression where rates kind of drifted higher. And I think we're in a similar dynamic now where rates are just going to kind of chop around. And if they set a higher low from zero, that in and of itself is a tectonic sea change difference for all investors. And I don't think enough people really appreciate that. There's entire portfolios built around the dynamics of the last 30 years. And so if those things are changing in any really material way, it will take years for the market to really adjust to those things. I would not want Powell's job at all. It's interesting if you go back and you read FOMC transcripts from way back in the day. I'm a mutant, so I do things like that. There's one from like 2012 when Powell is really new to the Fed system. He's like a vice chair at one of the banks. I forget which one. And he basically, they're talking about, they've run QE, they're on like QE 2 or 3 in 2012. And they're buying these mortgages. And Powell did not like that they were buying mortgages. And he did not like that there was no clear plan to unwind the balance sheet. This was 12 years ago.
You can kind of see this thing playing out.
Right. And he has some really remarkable quotes in that kind of exchange. I'll find it for you later and send it to you if you want to look at it. And one of the things he says is, I don't think we have a good plan here. It looks like we're blowing a fixed income bubble across the spectrum, and that when we try to unwind a multi-trillion-dollar balance sheet, we are going to run into significant problems in the years ahead. And he didn't know what those were, right? But here we are. He's been the chair since 2018, and he is dealing with the very problems that he had before. And there is no real elegant way out of this, I think, because of the way that we've constructed the system, the kind of pile of blocks that we've built up, the way the Fed has handled the last two crises. They've kind of set themselves up where there aren't great solutions. They can't reduce the balance sheet that much. And with Yellen and him working together, sometimes at cross purposes, it's sent a lot of mixed signals to investors and economists just in the last couple of years here, right? I mean, a lot of the games they've played with the types of issuance, Yellen leaning really heavily towards issuing more bills, and think that's been a major catalyst. In fact, that really kicked off the rally around Halloween of last year. There was a QRA, a quarterly refunding announcement from the Treasury that came out, and there was a surprise, very slightly less amount of duration and more T-bills, more shorter end issuance, and that sparked the rally. And then a couple of weeks later, Powell's FOMC, he was very excited, very giddy, talking about rate cuts, and just that kind of those amalgamated together and to just form this mega bullish dynamic that we came into the year with. And that's just one of several things they've done throughout this cycle to really kind of prolong the strength of the economy while they watched inflation come down. I mean, I think you could argue the Fed has done almost nothing to inflation. They didn't really cause it to go up or to come down. All the stimulus caused it to go up. They were late to reacting to it, but maybe it would have just come down on its own anyways. And so it's like, what are they even doing? They're just, are they just portraying the image of control? Because that's what I think they're doing a lot of the time.
I agree. I think essentially jawboning, and it's all about training the investor reaction function, right? And it's all incentives. They've created this 40-year deflationary period where people always expect that it's going to be the exact same. Now that we're in a new set of rules and their hands are tied in various ways, but also what is the actual role of the Fed? Do they actually have much of a difference, or does the market tighten for them, right? The bond yields all move based on the way that they're priced, the demand for government debt. You mentioned Yellen, going onto the shorter duration. I think Luke Groman was talking about, I like this framing. If you think about what long duration bonds are, they are an asset because you are taking on interest rate risk. In theory, you get paid more, not recently, but you should get paid more for taking longer duration risk. And as you go to the shorter end, let's just imagine, for example, you bought, a 3-month treasury bill at 2%, and then Jay Powell keeps hiking rates to 5%. And you're like, well, if you got a 10-year bond locked in at 2%, stiff shit, you're going to hold that 2% shitty asset, and everyone else is getting 5%. But if you've got a short-term bill, you can hold it for 3 months. Be like, okay, sure, I lost 3 months at 2%, or I lost 3% over 3 months. I'll just roll it at the end of the day. So they're a much more cash-like instrument because that risk is gone. And if you look at what Yellen's been doing, and the government, by and large, they have been issuing more cash-like instruments, less assets, because the market can't absorb the asset side of the equation. And what does that look like? It looks like monetization. You are getting closer and closer to a cash-like instrument. It is monetization of the deficit. And these are these big competing forces. We have this economic malaise we were talking about previously, but then you've got this competing factor. That's the gravity. What we discussed in the first part of this conversation was the gravity, where the system wants to go. And now you've got the counteracting force, which is the government trying to prevent that from happening. They don't want the economy to go into a depression, and they need to refinance all this debt, and they need to issue new debt, because there's the one thing that's not on the US election ballot is a fiscally responsible government. Correct. So that's the one thing that will not happen. So it's this, like, these two, it's the immovable object trying to, compete the, the unmovable force, the unstoppable force. These are things that are trying to meld in the middle, and it is going to be tumultuous. That's the only thing I can envision. And I think previous ways of thinking will get people stuck. They will keep looking for the 4-year Bitcoin cycle. They'll keep looking for the tip. It's not going to be typical. This time is actually different. And you have to look at the individual mechanics as they play out, and expect these big forces to come in, usually in reactionary and late to the party.
Absolutely. I do think you have to start thinking a little differently. I see what I would characterize as a lot of lazy cycle analysis, where folks just kind of
Yep.
slap a fractal from 3 years ago onto the price chart and say, well, this is kind of what it looked like last time. So I think we're just going to go up. And
Don't
that
worry, bro.
worked.
We're going to top it in December 2025. Note it down, right?
Right.
It's like based on.
I don't think that those models are very useful right now. There's
Agreed.
too much that has changed, and we already were kind of in a state in crypto where, or at least in Bitcoin specifically, where people, I think, credited a lot of myopic Bitcoin things with what's happening with the price, when actually the forces driving the market are larger and bigger than Bitcoin. It's just a lot of times as Bitcoiners, we get very singularly focused on this asset and what's affecting it and how it's performing, when really it's being driven by larger forces outside of it. And this is one of those periods of time where if you are blind to the macro, I think you can find yourself caught off guard if you're just relying on traditional cycle symmetry. And something I've said since last year, I tweeted it in a lot of ways. Sometimes I do a little engagement farming for the social media clicks, but this time is different. And this is most likely the cycle where prior historical symmetry is challenged or broken. And those things that will happen at some point. And if I'm a betting man, I would wager that this environment is the one where those patterns break. And so far, it seems like maybe that will be the case, though we certainly don't know. Bitcoin could turn right around and shoot up and go to 100K in the next 3 months, and I'll look like an idiot. But I just genuinely believe that we're going through a period of great global change, not just that we're at the end of a business cycle following a bunch of stimulus. I mean, that in of itself is an issue, as we've been talking about a lot on this conversation, the issues with the Fed and how they're going to stimulate whenever we do kind of run into the last little vestiges of growth strength that we have in an economy with no credit growth. I don't know what that looks like, but it's not just what's going on in the US. Stan Druckenmiller has this great quote that the worst economies follow asset bubbles. And that's historically true. And if you think about what 2021 was, it was the greatest asset bubble we've ever seen globally, right?
The everything bubble. That was the everything.
It literally was. And when I've brought this up to folks in crypto and on crypto Twitter, they often push back and say, well, the 2017 crypto altcoin market was bigger. There were bigger gains. Yes, that's true, but it was also going from 50 million. Yeah, it was going from $50 million to half a trillion or whatever. So 50 billion to half a trillion. So like it grew a lot. But the scale of what we saw in 2021 globally has never been seen before. Luxury goods, home goods, commodities, every single
Pokemon cards,
market,
you name it.
Pokemon cards, everything, fucking Hermes bags, everything. And we still haven't fully deflated a lot of that. Like I said, home prices in the US are still up since that period of time. And we have with way too much debt, not just in the US, but most developed nations, like most G20 nations, are beyond what Reinhardt and Rogoff would say is like the point of no return when you have to run financial repression. They've written research papers about this at the IMF. And I just, when you think about that and how certain global trends like our cooperation with China, those things were already starting to unravel before COVID. Like during Trump, right? We were already starting to have the tariff wars. They had stopped funding our deficits at nearly the scale that they were. Now they're net sellers of US treasuries. They have their own, China has their own problems. They've absorbed a lot of our expansion and helped to power our economy and the global economy for the last 2 decades. And they are no longer in a position to play that role, at least for now, until they resolve their great financial crisis that they are currently going through.
They're in 2008 mode.
It's almost exactly 2008 in China. It's just that they're communists. It's like them only. Other than that, it's the same set of problems, and I think that those factors, and we could name 20 others, are they exemplify that we are in a period of change. We have left the lower bound on interest rates. Inflation has been reawakened, whether it goes back up to 9 or it just kind of stays sticky and relentless and hangs around in the background. It is now a factor, whereas before it was not. And I think that this will take years to resolve, right? Like COVID basically picked up the entire global economy and shook it like a rug. And we've kind of had this ripple effect for a couple of years. And we're still riding some of those waves. But you asked a question like, what are they going to do in the next downturn? I don't really know, but if I were to guess, if it's any time in the next couple of years, I think they will be significantly hampered in their ability to respond like they did for COVID, right? Because COVID was done deliberately and artificially. They knew that they were doing it. They knew that by doing it, they risked a depression, and thus a tremendous response was required. And so Powell and Congress got together. Powell said, you guys spend the money. I'll support you. We'll make it happen. Otherwise, we're going to have the Great Depression. And so they turned, they did what they did. And I think, right, I'm not saying that they won't try to stimulate or that there won't be efforts taken. There certainly will. But I question their efficacy. I question their ability to do the same thing just a couple years later. In a downturn that they have not generated, right? That they don't know the scale of, that they don't know the start and end point for, because they didn't make it happen themselves like they did in 2020. And so I just believe it presents a different set of factors. And when you add in the problems with how we raised rates so fast and we haven't raised the cost of capital for anyone in that interim, that those two problems just don't line up for me. And I really think that most people just don't even know how to think about these problems when we encounter and when we're going to encounter them next. I don't think many people are even considering it.
Fully agree. And I think the way that I kind of approach this whole thing, right? Because if we start to move it like, what the hell do you do, right? In a position like ours, how do you actually protect yourself, prepare for all this kind of thing? And something that I've found really interesting, if we look at what's happened in equities and what's happened in crypto, we've seen the same thing. We've seen the Magnificent Seven and the Magnificent Bitcoin and Solana, and that's about it. What does that really tell me? What does that actually tell me? Most companies, most shitcoins cannot outrun, because they are going to have to debase the currency. At the end of the day, whilst we're going through the tumultuous chopsolidation, stagnant quagmire malaise, that's probably the foreseeable future. That's what it looks like to me. The end result is the currencies will get killed, and they have to do it on a relative basis, right? You can't have one country printing, everyone's going to print at the same time. So the end result is going to be the same. And it's one of those things where you're going to get one of these repricing events where just the right assets are going to move, everything else probably not so much. So for me, the way that I've really broken this down, we are literally seeing evidence that every company is a zombie company with the exception of like 2 or 3, right? 7.
Right.
Everything is a zombie. And likewise with crypto, the thing with crypto, it's even more interesting. There's no question that the crypto natives in this world fully allocate. I've heard from so many institutions as well, were fully allocated to ETH, expecting that it was just going to be alt season straight off the bat, right? And what's happened is, unless you are in a handful of alts, you've been absolutely murdered. And most people who then flipped into those ones have been murdered since then. I can't help but feel that we are really heading to a world where there are going to be very, very few assets. And let's think about this. Gold, right, is 13 trillion. I mean, you probably know the numbers better than I do. What the size of bonds is hundreds of trillion. The size of equities is like in the tens of trillions, right? So we're talking about assets that are orders of magnitude bigger than gold. And that's an order of magnitude bigger than Bitcoin. To me, and then like, I think, I don't know the numbers, but if you look at energy stocks are like a fraction of a 15th of nothing of the overall US market. What are the things that are going to perform well in this environment? Stuff that we need. Full stop. Stuff that we need. So my like core thesis, what are the things I want to own? Knowing that the next couple of months, maybe 12 months, are going to be a just choppy mess. What are the things I want to be building the position in? For me, It's gold, it's Bitcoin, it's energy stocks. You could argue commodities, but I think I'm more than enough levered on those other assets. They're the things that I want to own because that's what makes sense. And I can't help but feel that at a higher cost of capital, we move away from monkey JPEGs, which quite frankly make no sense. And we move towards things that, let's just be really rational, sensible human beings. What makes sense? We need energy. We need scarce assets to protect from the debasement of currency. And that's just, I think people overthink this to such an extent. That's the conclusion that I've come to. And it's like, you just have to grit your teeth and survive and acquire the positions and not blow up, acquire the positions you want, because when it happens, it's going to happen very, very fast.
I think I am fully aligned with your thoughts about your portfolio and which assets are important. I think scarce assets, hard assets, things we actually need and use are of value. You mentioned commodities. I own some gold. I own some silver. I obviously have Bitcoin. I would like to increase my exposure in that realm. Lynn Alden does some great research on some of the kind of like midstream producers and things like that. And some of her plays, I've got some allocations in. And I think I'm pretty well set up there, but I'd like to increase them. And I think Bitcoin will do well. I sound very bearish on Bitcoin a lot of the time, but it's really only related to this cycle and related to the level of uncertainty that I think we have and my very well-reasoned explanations for why I think price will be unimpressive, at least in the short term, right? But I do believe that the foreseeable future is one where an outside asset such as Bitcoin and like gold and like silver are likely to do fairly well.
And just one point on that, I think another component that's massively underappreciated is that they're the only global assets. Global.
Right.
Every single country is dealing with the same shit show. And
Right.
gold, silver, Bitcoin are really the only asset that people everywhere in the world can buy, and the whole world is in this mess, right?
Mhm.
Of all sizes and shapes. They're the only assets that have a global demand profile. They trade in every fiat currency, and I think that's a massively underappreciated sector to this whole thing.
I think so too. One of my theses about Bitcoin has been that I don't think that it's setting up to replace the entire global financial system or replace the dollar or anything like that. But I do think that it will play a significant role and that it will be worth a lot of money over time. And it's about what we're talking about here and the changes to the global financial system and how I believe outside assets stand to benefit. And if you look back through, eons, whenever there have been losses of confidence in a system, loss of confidence in a government or a currency, people move to real assets, to commodities, to metals. Sometimes they've moved to actual goods like grains and things like that, really long time ago. But gold has been kind of the mainstay, gold and silver. And a lot of Bitcoiners think gold is kind of this worthless shiny rock, and in some ways they're right, but it is still valuable. It still has a role in the minds of investors, and because of that, it is significant. And just look at what central banks.
It's big enough to absorb capital. It can't, like Bitcoin's not a big enough sponge yet.
Right, it's not big enough yet. And just look at central banks. They still treat it as an outside asset. The central banks in the East have been hoarding gold the last couple of years for good reason. And so I think that as we enter whatever the next crises look like, and we inevitably will, that in each subsequent one, Bitcoin will see a new impulse of owners, right, who in prior generations could only choose between gold and silver or something, some other thing outside the markets. And so I think that's where its path to growth is, really, because we're in late stage. We're in like the fourth turning of the debt monstrosity that runs the global financial system.
We're in the eighth innings of this whole thing.
Yeah, the next 10, 20 years are going to be tumultuous. Periods of growth and periods where things are fine, but I think a lot of changes will occur, and it will be interesting to own Bitcoin and gold throughout that period. And that's where I come at with Bitcoin as a Bitcoiner. I don't talk about it in terms of replacing the dollar or like all markets being priced in Bitcoin or anything like that. I think really that as currencies one by one fail, that more and more allocations will be made outside of the traditional rails, and it's going to benefit in that regard. It's just it's a non-linear path. And I don't believe that the patterns that we've experienced the last 15 years in Bitcoin are what we have to see for the foreseeable future, just the constant like this. I don't think it's just going to do that. And like if we're in an environment where that could begin to change, this is it.
And something that I've been talking about quite a bit is that like this cycle is very, very similar, if we want to call it a cycle. It's much more similar to 2016, 17 than it is to 2021. And
Yes.
if we talk about what, and you mentioned it before, what was that 16, 17 period? That was an adoption-driven cycle, right? It was a bull market that was driven by people who actually demanded the asset. What we're seeing in 2021 is that was not what I would call a true adoption cycle. That was a pure stimulative monetary impulse. So in a way, when I look at the current market, to me, it's still, even though we had this nasty ass red candle the other day, it is still within the context of chop solidation. It is still within the context of what looks, at least to me, when I look at it on a monthly chart, it looks like a monthly uptrend and a big weekly downtrend. What we're seeing is this like boring repricing higher. Events happen where the market goes higher. It has to go down before it can go up. You've got to work out all that kind of interim noise, but we go down and then we reprice to a new level. And then it's going to be super boring again as we just like malaise around and try to find that new level. And people are going to be expecting this like beautiful parabola. And I think they're going to leave because they're bored. Even though I believe we are in a long-term bull market, it's going to take longer than people expect. It's going to go through periods of non-linearity that people can't comprehend and think about. And it's one of it's the classic example. I need to do this study. We've been meaning to do it for a long time. You know, it's like 6 days out of the 4 years. If you're not there for those 6 days, you lose like 80% of the returns. That to me is what it's going to look like. So many people are going to leave out of boredom because it's just not going to look the same. It's actually a adoption-based cycle. Takes longer, but people are going to demand it because they actually need it to avoid the debasement that comes. But it's a slow, macro scale glacial process with short bursts of decades in a week.
Yeah, I think that's fair. And you said earlier, like this cycle is definitely different, and it absolutely is.
Measurably.
Yes, in so many different ways, in timing ways, in actual dynamics on the price chart, all of those. Economically, it's very different. Like the devastation, you mentioned the altcoins earlier, and I wanted to say, you know, the devastation of the altcoins is tremendous. Like we've had bull markets where altcoins pull back 50, 60% in the middle, but when they do that, they maintain their market structure and they're still on a high time frame uptrend. You just go look at the charts. They don't completely break down and give back the entirety of their gains so far in the uptrend. And that is exactly what the majority of the altcoins have done just in the last 4 months.
And the mask is also off where I think the crypto natives have actually said it out loud that we actually haven't built anything. There's nothing, there's no there. And I think the market is now going, well, in this world, I don't want to own nothing. I want to own something that's got some actual juice to it.
Yeah, I think that we're obviously there's some coins that go away in every cycle, but I think we're probably due for a significant amount of the top 100 to kind of drift into obscurity.
A great extinction event, so to speak.
Yes. We
had absolutely. The Cambrian explosion some time back, courtesy of that's
a great way to put it. The Cambrian explosion, yeah,
the Cambrian explosion, which is a JP's line down here in Sydney, and now we're seeing the asteroids start to come in and actually wipe out some of those life forms.
It's the same thing as the zombie companies, right? If you look at the Russell 2000, it's been below its high for 3 years. And everyone's been talking about how strong the stock market is. It's really just the mega caps that have been the larger companies. Right. It's the larger companies. But if you look at the stock market, like half of the top 100 companies haven't made a new high in over a year. And it's really like the top 30 companies that are doing all the work, top 20 companies to varying degrees, the top 10 really. And that's not a healthy dynamic, but it's creating this illusion of all this strength and all of this risk taking. But really, they're just very concentrated bets that everyone is piled into, and they're not really trading anything else. And that's kind of the same thing we saw in crypto. You know, like when we think back to when Yellen did her little QRA trick in Halloween of last year, and the NASDAQ took off, the Dow Jones took off, Bitcoin took off, everything took off. It was ironically only about a week after that fake Cointelegraph tweet about the ETFs. So I just want to point that out. The timing is hilarious. But so for about a month and a half or so, until I would say Christmas, every crypto in the market went up about the same amount. They all went up about 100%, roughly, like 80 to 120%. And then a bunch of them just kind of stopped there, and they weren't really able to continue into 2024 when we saw the memes pushing higher, Bitcoin, Solana, and the ones we know went higher. But a lot of the market pushed up, and then it just wasn't able to continue. Things like
no momentum.
Cardano is a great example. If you look at it, it went up and then it just kind of faded. It didn't really do much at all. A lot of charts look like that. And I really think that we have to kind of go through a period where we just wipe out a shit ton of old projects that people thought were worth something, that maybe have pretty impressive market caps in the hundreds of millions or billions of dollars, that actually are, to give the maxis credit, function just completely worthless things. And the market can give something a value that is worthless for as long as it wants to give it a value. People used to trade Beanie Babies, but I do believe that we will reach a point, maybe it's in the next couple of years here, where the lack of there, to use your phrase, actually manifests in the disappearance of these projects. I don't really see how it couldn't result in that.
Yeah. So just to kind of close out this thing, I'm curious, just to kind of round this whole thing out. Do you expect a rate cutting cycle, right? Do we actually expect that this is what's going to happen? I agree with you on the higher low at the end of the day. What is kind of the trigger point? I can't help but feel that, like, once that higher low is established, that to me is where the market probably finds, I don't know which trend it will be, but that's where it probably finds some kind of longer lasting momentum, when the market, as you said before, accepts that higher rates, we are going to be higher for longer. And higher doesn't necessarily mean 5, but it certainly doesn't mean 0.
Right.
So setting that higher low to me feels like when, whatever this malaise is, and again, this doesn't mean that assets can't go up, down, left, right, and sideways in this process. It's completely variable. I think anyone who says they know what's going to happen in the next 6 to 12 months is kidding themselves. But my gut feel is that once the market accepts that higher low is established, that's where we can start to refactor and go, okay, here's the actual trend that we can start moving towards. I would say that by that time, the monetization of debt, the financial repression that I think is highly probable to happen,
yes,
that will be in full steam ahead. But it's that, do you kind of see that we're in the malaise until that point happens? Is that like your trigger, or what's your trigger for saying, okay, now we've got a bit more confidence that the thesis has kind of played out and we're now moving to the next phase?
I do think it's that. I think, obviously if they just come out with $30 trillion of printed money overnight, if they just do COVID times 2, then forget everything I said, and we're just going to go straight up.
Buy Pepe.
Right, then it'll be the David Hunter melt up, and no one's going to want to see the market after that's over with. I don't want that to happen. But if that happens, then everything's out the window. But all else being equal, yes, I think what we have to look for is the credit edifice to start moving again. It's like the Jawas sand crawler. It's just kind of moved to a stop, and it's just this huge mass, and it's not going anywhere. We're not making any new mortgages. No one's selling their homes. No one's buying new homes. Businesses aren't taking out debt. Everything's just kind of frozen in place. And during that period of time, the market has been obsessed with interest rate cuts, right? As long as we have not been creating credit, what is the dominant narrative? Pivot, 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 pivot. Since the middle of 2022, when credit stopped moving, that has been the dominant narrative, and the market has been continually wrong about it, hoping for those cuts. I don't know how we get there, but the Fed will lower interest rates. I think they'll lower interest rates next month. I think so too,
because they tend to do what the market tells them to do, generally speaking.
Right, and they've laid a lot of groundwork for this, and so I think that they will do that. I don't know if they'll do it again in November or if we'll do a wait and see. But I think that over the next 15 months, we will get a couple of interest rate cuts, 2 to 4 interest rate cuts. And the question will be, does that reaccelerate the housing market? Does that cause consumers to take on a little more debt? and use their credit cards and spend a little bit more. Because if those things don't happen, then we continue to ride on the same moderately slowing consumption and driven by wage strength. And I don't want to get off on a tangent on that. I want to stick to your question. Your question is like, is that the trigger? I think that it's the biggest question in this cycle is, will the economy accept rates above zero? And what is the rate that they accept? We don't know what it is. We do know that half of all mortgages are locked in below 4%, and 4% is what mortgage rates were at when the Fed started raising interest rates. They had already drifted back up to 4. So the likelihood that they go below that is almost nil. So half of the mortgages are just kind of off the table. The only ones that will move are the people who have the money to move, and they just don't care. They're just going to do it anyways. But there's another pocket, another 25% of the country has a mortgage between 4 and 5%. And so maybe if the Fed lowers 100, 150 basis points, maybe a few of those people start to refinance. Maybe we get a little boost to consumption. Balance sheets start to look a little different. It's a big mess. You know, it's kind of hard to see what the specific thing will be. This is not like past cycles because of the zero bound, because they can't just push the rates down to a new low and stimulate everyone. It's going to happen very piecemeal. And that's why I think it will take a long time. That's why I think that even when they begin to cut, we're probably in for an extended period of that, unless we just fall off a cliff economically. But if we continue on this pace, I think it's the malaise that we talked about, the chopsolidation, the stagnation, where we're not really growing that much, but we're still in the black. Employment is still positive, but it's not great. And inflation is between 2 and 3%. And the Fed cut a little bit, but they can't cut a lot in that environment. And that's what we've seen for the last 8 months, 9 months. And I think we're going to continue to see that, barring, like I said, an actual just falling off a cliff. And it's very uncomfortable for people to think about that. I think everyone kind of wants a resolution, something, let's just get out of here. Let's break out of it. We start cutting and we're out of here. But to bring it back to one of the catalysts you mentioned earlier, the yen carry trade, when you lower interest rates in the US, you close the differential with the yen, which is the borrowed currency for for trillions of dollars of leverage. And just as we have seen in the last couple of weeks with the rapid falling of US yields and a hike by the BOJ that caused this, or at least contributed to the move that we've seen in the last couple of days, I would expect some element of that to come back when they cut rates again, because this carry trade isn't going to go away. And it's just, man, this is a shit show, Check. This is a real shit show. It's not a clear outcome. There's not just a simple couple of things that they can do. The deficits are so low. This is the largest deficits in the U.S. that we have ever had in peacetime. Where do they go after if we have a crisis? Do they just get bigger? There is no good solution. And I know I sound like a doomer when I talk about these things. I wish I had like a more constructive, well, they could just do X, Y, and Z, and I think it's a really elegant outcome.
I don't think anyone's got that answer, though. That's the problem. And that's what's so fascinating about this cycle is the smartest people in the world are going, and I think the correct answer is, I got no idea. And
I got no fucking clue, man.
And nobody does. And I think, you have to be so deep in this stuff. And, even Fed insiders, right? People who really know how the system works, they have no idea how this works. The scale and size of this stuff. The yen carry trade is trillions of dollars. No one actually knows how big it is. Right?
It's not even the largest carry trade. Like there's actually larger carry trades than the dollar yen. It's just, and that one alone is fucking us up.
Yep. And that's the thing, right? So maybe let's close out on this. In terms of like some advice for listeners, like things, and I like to come at this from like the perspective of the hodler. And I've been using this persona like this: check the analyst and this check the hodler.
Right.
This is like from check the hodler, just be really, really patient, because if you set your expectations that we have to moon tomorrow, like the debasement, the financial repression, all the things that we've studied, learned about, understood, the reason why I own Bitcoin and gold, it's going to happen, but it's going to happen at a time frame that's going to be a lot longer than people expect. There'll be a whole lot of chop between now and then. And when it happens, it will be non-linear and it will occur in bursts. It won't be this kind of like, oh, we're going to get this beautiful parabola, or we're going to get this just vertical. I mean, the 2021 went straight up with not a single break, and we filled that whole triangle back in. So leave those concepts behind. be patient, survive. It's going to happen, but it's going to take a long time, and you just got to get to the end of it.
Mhm. Absolutely. The number one rule in markets is survive until the next day. Whatever you do, don't die in market terms, right? Stay
Yep.
afloat, stay solvent, don't lever yourself.
Don't
Uh,
lever up.
right. Like, continue to slowly nibble at those hard assets and things that you have the absolute highest conviction on. And what I've recommended to like my friends and family, because it's what I would suggest to anyone as we enter a period of uncertainty and potential economic straits, is get your financial house in order. You need to prioritize the debts you have by interest rate and start paying them down in descending order. You need to go through all of the subscription services that you're subscribed to and cut the dead weight. You can always sign back up. People carry hundreds of dollars in monthly payments on subscription services to TV and streaming and this and that web product and things on their phone. And you could save hundreds, thousands of dollars and put that into Bitcoin or gold or XYZ hard asset. I recommend people do those things and just keep yourself liquid, keep slightly more savings than you would have kept a couple of years ago, and just like you said, be patient and try not to get wrapped up in what people on Twitter are telling you is going to happen. They are so
Absolutely.
wrong all the time, and I'm sure that you experience this as a serious analyst. I find that when I spend time on Twitter before looking at the markets myself for that day or that week, it greatly influences my opinion about what I'm looking at, what's going to happen. And so I have to kind of like put it away and go form my own opinion about everything and then come back. And I really encourage people to do that, especially in this period of time, because this environment is the kind that's, to use a crude phrase, separates the men from the boys. It separates the wheat from the chaff. And so if you have
Oh, yes.
people doing lazy analysis, people relying on recent historical patterns to endure, or who just don't understand the complexity of the situation we're facing, as we've been talking about for like an hour now, those people who don't understand that will lead their audiences to the slaughter. And that's my greatest concern, is just that people get over-indexed to the recent past when the underlying conditions are not supportive of that outcome. Not that it can't happen, but that it's actually probably the lowest probability outcome that we just repeat something like 2021 again, much more likely to be something we haven't seen before in Bitcoin.
Yep. No, 100% agree. And the line I use is I love seeing the narratives on Twitter not playing out in the data. And I know you probably see that more often than not.
Absolutely.
Yeah. No, it's
Yeah.
great. Mate, this is absolutely fantastic. We have to do this more often, but I hope people enjoy it. I mean, it's just a kind of bouncing ideas around. I mean, there's a lot of stuff we talked about in the pub over there in Texas, but mate, thanks so much for your time, and what a fantastic conversation.
I appreciate you having me on. I hope your listeners enjoyed hearing us chat. And I just want them to know that I have the utmost respect for you. You were one of my earliest mentors when I was learning about Bitcoin on chain and getting familiar with the space. And so you're one of my friends, and I've just got a lot of respect for you. So I love what you're doing with Check on Chain, and keep working at it, buddy. And if you want to have
No,
me back
likewise.
to talk, I'll be glad to come anytime.
No, absolutely. And few people do as much proof of work as you. And I've I see the comments, right, and people in your threads, and they don't understand the level of work that you've done. They can't understand the timeline, right? You're looking at things in terms of like you're doing on chain for the economy, essentially. You're looking at what are the real mechanics that drive this thing. Few people do it. I think you're fantastic at it. So, mate, what a pleasure.
Well, thanks, bro. Take care, and hopefully we talk soon.
Sounds good. Cheers.
Cheers.